I am Dr. Divya Verma Gakhar and I welcome you all in Gurukul Live lecture series on for the subject Financial Markets and Institutions. Today the topic of discussion is going to be money market instruments. Money market is that part of financial markets which is related with securities of short-term maturity. So any financial instrument which has short-term maturity of less than 1 year is a part of money market. Money market has a very important role to play in the financial markets of any economy because they regulate the supply of money. They regulate the supply of money with the financial institutions and banks, and thus the flow of money in the whole economy is affected by it. So today we are going to start with the discussion on money market in India. Money market basically is a market where money or its equivalent is traded. It is a wholesale market of short-term debt instruments and is a synonym of liquidity of a market. Money market is a part of financial market where instruments with high liquidity and very short-term maturity, which is less than 1 year, are traded. RBI has defined money market as the center for dealing mainly short-term character in monetary asset. It meets the short-term requirement of borrowers and provide liquidity or cash to the lenders. Hence, money market is a market where short-term obligations such as Treasury Bills, call and notice money, certificate of deposits, commercial papers and repos are bought and sold. The purpose of money market of any economy, it plays a role in the transmission of monetary policy impulses. So, banks, they borrow in this market to fill in the gap of temporary mismatch of funds, to meet the cash reserve ratio and statutory liquidity ratio requirements as stipulated by the central bank, to meet sudden demand for funds arising out of large outflows like advanced tax payments. Call money market serves as the role of equilibrating the short-term liquidity position of the banks. There are various money market instruments which we will discuss today. These include commercial bills, treasury bills, call and short notice money market, certificate of deposits, commercial paper and repurchase agreements. For any money market to be a developed market, there are certain characteristics which we need to understand. So, it has to have a developed commercial banking system. There has to be a presence of a central bank just like we have RBI. There are sub-markets in a developed money market. There are near money assets which are available, and there are availability of ample resources, and the interest rate structure is integrated within the system. The function of money market includes that money market helps in economic development of the country. They leads to profitable investments. It helps the government to borrow money for the short term period from the economy, from the public. It is very important for central bank because central bank can cover its monetary policy with the help of see the liquidity of the market based on the money market. Mobilization of funds is possible because of the money market. It leads to self-sufficiency of commercial banking, and it also promotes saving and investment in the whole economic environment of the country. Money market has various features. There are transactions that have to be conducted without the help of brokers. It is not a single market. It comprises of several sub-markets like call money market, acceptance and bill market. The component of money market are the commercial banks, acceptance houses and NBFCs. In money market transactions, the transactions cannot take place formal like a stock exchange. They happen only through oral communication, relevant documentation and written communication. The transactions are done. The objectives of money market include that it provides a reasonable access to users of short-term funds to meet their requirements quickly and adequately at a reasonable cost, to provide a parking place to employ short-term surplus funds. It provides room for overcoming short-term deficits, to enable the central bank to influence and regulate liquidity in the economy through its intervention in the market. There are various players in the money market. First one is the central bank, that is RBI, Reserve Bank of India. Apart from that, there are Discount and Finance House of India, which is known as SBI DFHI Limited, which was amalgamated with SBI in 2004. Then there are acceptance houses who play an intermediary, And then there are interested parties, which include commercial banks, cooperative banks, primary dealers. They are allowed to borrow and lend in this market. Apart from that, there are specified all India financial institutions, mutual funds and other specified entity which are allowed to access to call and notice money market only as lenders. Individuals, firms, companies, corporate bodies, trusts and institutions can purchase treasury bills, commercial papers and certificates of deposits. RBI has very important role to play in the money market of a country. It ensures that liquidity and short-term interest rate are maintained at the level consistent with the monetary policy objectives of maintaining price stability. They ensure an adequate flow of credit to the productive sector of the economy, to bring about order in the foreign exchange market. There are various instruments of money market. Popular ones are treasury bills, commercial bills, call money and promissory notes. Apart from that, there are some new instruments which include commercial papers, certificates of deposit, repo instruments, repurchase agreements, banker accepted notes and mutual funds. In the organized money market, there is call money market. In the bill market, there are two types of bill, treasury bills and commercial bills which are traded. Short-term bank loans are a part of the money market, and organized money market comprises of RBI, banks, commercial and cooperative society. Now, talking about the first instrument of money market, which is call and notice money. It is a part of national money market. Call money employs day-to-day surplus fund mainly of banks. They are traded. It is short-term in nature and has a very convenient interest rate available. The maturity of these loans, which are known as the call money, they vary from a loan which is for 1 day up to 15 days. If money is lent by any bank, by one bank to another bank for 1 day, it is known as call money. If the money is lent for more than 1 day up to 15 days, it is known as notice money. So, money market is call money market provides highly liquid loans which are repayable on demand. Money which is lent for more than 15 days is known as term money. The borrowing in the call money market is exclusively limited to banks who are temporarily short of funds. The main function of call money market is to redistribute the pool of day-to-day surplus of funds of various banks among other banks who are temporarily short of funds. The call money market helps banks to economize their cash and yet improve their liquidity. If money is lent for 15 days, it is known as term money or notice money. Term money market is another segment of uncollateralized money market. That means there is no collateral which need to be deposited by one bank to other bank if they want to carry on some borrowing and lending between themselves. The maturity period in this segment can range from 15 days to 1 year, and the term money market has been somewhat dormant in India right now. It was also a strictly regulated market up to 1980s with a ceiling rate of interest of 10.5 to 11.5% across various maturity buckets. There are various call money market participants, those who can both borrow and lend in this market. So, one is RBI through the liquidity adjustment facility. Then there are banks and primary dealers who participate in this market. Once upon a time, select financial institutions like IDBI, UTI, mutual funds were allowed in the call money market only on the lender's side. But ultimately these things were phased out, and call money market is now a pure interbank market since August 2005. Banks borrow in this market for the following purpose: to fill the gap or temporary mismatches in funds, to meet the CRR and SLR mandatory requirement as stipulated by central bank, to meet sudden demand for funds arising out of large outflows. Now, if you look at the data of money market, especially the call money, tri-party repo and market repo rate, this data is very recent, as updated on 4th of June of 2019. Now, this table shows that there is volume and the average weighted average rate which is given. Now, we can see that weighted average rate of return is 5.87 for the call money. For tri-party repo rate, the rate is 5.79, and for the market repo rate, the present rate is 5.85. So, the call money repo rate, call money interest rate varies from a range of 4.5 to 6 For tri-party repo rate, the rate varies from 5.7 to 6 and market repo rate varies from 5 to 6.17. And the amount of volume which is being traded in the call money is 168.33 billion as on 4th of June 2019. And all this data is updated on RBI's website on daily basis. Looking at the term segment, which includes notice money, term money and repos in the corporate bond, if we see this data, the rate of interest which is available for notice money for interbank transactions for 15 days time period is 5.79. So the lower limit is 5.10 to 5.95% rate of interest, and 1.04 billion is the amount of call notice money transactions which are outstanding as on 4th of June 2019. And for term money, this amount is 0.75 and the interest rate varies from 6.10 to 6.25. Now coming on to the second instrument, which is certificate of deposits. Certificate of deposit is another instrument which is a part of money market of India, and these are short-term borrowings in the form of USAN's promissory notes issued by all scheduled banks and are freely transferable by endorsement and delivery. These were introduced in India in 1989. A certificate of deposit is a time deposit with a bank. Certificate of deposits are negotiable money market instruments and are issued in dematerialized form in the form of USAN's promissory note for funds deposited at a bank or other eligible financial institutions for a specified time period. They are like bank term deposit accounts. Unlike traditional time deposits, these are freely negotiable instruments and are often referred to as negotiable certificate of deposits. Certificate of deposits can be issued by scheduled commercial banks, excluding regional rural banks and local area banks, and select all India financial institutions that have been permitted by RBI to raise short-term resources within an umbrella limit fixed by RBI. Like most of the time deposits, fund cannot be withdrawn before maturity without paying a penalty. Maturity of not less than 7 days and maximum of up to a year. Financial institutions are also allowed to issue certificate of deposit for a period of between 1 year and up to 3 years. They are subject to payment of stamp duty under Indian Stamp Act 1899. These are issued to individuals, corporations, trust, funds and associations. Usually, the certificates of deposits are issued at a discount, freely determined by the rate of the market or by the investors. The features of certificate of deposits include the minimum period is 7 days, maximum period is 1 year, minimum amount of investment is 1 lakh and in the multiples of 1 lakh thereof. Certificate of deposits are transferable by endorsement. CRR and SLR are to be maintained with the help of certificate of deposits. Certificate of deposits are to be stamped. A certificate of deposits may be issued at a discount on face value. All of the over-the-counter trades in certificate of deposits shall be reported within 15 minutes of the trade on the reporting platform of ClearCorp Dealing System India Limited, CDSIL. Banks, financial institutions cannot grant loan against certificate of deposits. Furthermore, they cannot buy back their own certificate of deposits before maturity. All over-the-counter trades in certificate of deposit shall be cleared and settled through authorized clearing houses, which includes National Security Clearing Corporation Limited, India Clearing Corporation Limited ICCL and MCX Stock Exchange Clearing Corporation Limited CCLI of the stock exchanges. Certificate of with respect to India, the data says that average outstanding amount of certificate of deposit is 1638.51 billion with a rate of interest ranging from 6.65 to 8.60% from rupees 82.66 billion during 1992 to 1993 and rupees 3,290.96 billion with an interest rate ranging between 8.10 to 8.9% in 2015 and 16. So we can see that over these years the interest rate has declined, but the amount of transactions that take place in certificate of deposit, that has been increasing rapidly. Another phase of tight liquidity during East Asian crisis led to the increased market activity in this segment. The outstanding amount declined to 9.49 billion during 2001 and 2, reflecting the state of easy liquidity on account of large capital inflows. Third instrument of money market is commercial papers. Commercial papers is an unsecured money market instrument issued in the form of a promissory note. These were introduced in 1990s. Who can issue commercial papers? The commercial papers and certificate of deposit, one common difference between the two is that certificate of deposit can be issued by only a financial institution, which is majorly a bank or any other non-banking financial institution, but commercial papers can also be issued by corporate houses. So highly rated corporate borrowers, primary dealers and all India financial institutions can issue commercial papers. Largest issue of commercial papers are leasing and finance companies. To whom these commercial papers are issued? Commercial paper is issued to and held by individuals, banking companies, other corporate bodies registered or incorporated in India, and unincorporated bodies, NRIs, foreign institutional investors. All of these can also invest in commercial papers. The denomination of commercial paper investment is in the minimum of 5 lakh and in the multiples of 5 lakh thereof. The maturity of a commercial paper is minimum of 7 days and maximum up to 1 year from the date of issue. Eligibility criteria for the issue of commercial paper. Who can issue commercial paper? There is a eligibility criteria. The tangible net worth of the company as per the latest audited balance sheet should not be less than 4 crores. The working capital fund based limit of the company from the banking system should not be less than 4 crores. The borrowable account of the company should be classified as standard asset by the financing bank. All eligible participants should obtain credit rating for issuance of commercial papers. The minimum credit rating shall be P2 of CRISIL or such equivalent rating by other agencies. Process of issuing commercial papers. A resolution need to be passed by the Board of Directors. Commercial papers issued has to be rated. There has to be, you have to select an issuing and paying agent for the verification of documents. There will be arrangement for dealers for placement of commercial papers and report to the RBI regarding the issue of commercial papers. Activity in the commercial paper market reflect the state of market liquidity as its issuance tend to the rise amidst ample liquidity conditions when companies can raise funds through commercial paper as at an effective rate of discount lower than the lending rate of banks. Banks also prefer investing in commercial papers during credit downsizing as commercial paper rate works out higher than the call rate. The average outstanding amount of commercial paper as on July 2018 was Rs 3,583.97 billion with the discount rate ranging between 6.02% to 11.97% from Rs 22.80 billion during 1993-94. So overall rate of interest have declined, but the quantum of trading in the commercial paper and the number of commercial papers which are issued over all these years have increased drastically. Leasing and finance companies continue to be the predominant issuers of commercial papers. Discount rate on commercial papers have firmed up in the line with increases in policy rate during 2005-6 and 6-7. Fourth instrument is Treasury Bills. Treasury Bill is a secure government instrument which is issued for the Government of India by RBI. So Treasury Bills are short-term instruments issued by RBI on behalf of the government to tide over short-term borrowing requirements with maturity ranging between 14 days to 364 days. It is basically used to bridge seasonal or temporary gaps between revenue and capital of the government. Treasury bills are usually issued at discount to face value and are redeemable at par. For example, a treasury bill of rupees 100 face value is issued for rupees 91.50, gets redeemed at the end of its tenure at rupees 100 only. So that means 8.5 is the rate of interest which is paid on that treasury bill. Treasury bills are available for a minimum amount of rupees 25,000 and in the multiples of 25,000. At present, the Government of India issues three types of treasury bills through auctions, namely 91 days treasury bill, 182 days treasury bill and 364 days treasury bill, and there are no treasury bills which are issued by state governments. 91-day treasury bills are auctioned every week on Wednesdays. 182 days and 364 days treasury bills are auctioned every alternate week on Wednesdays. Features of treasury bills include that there is absence of default risk. It is the most safe instrument. So treasury bill rate is taken as the risk-free rate of return for various type of calculations which you use in mathematical finance. It assures fixed returns and there is low transaction cost. It has security for SLR purpose, so you can have treasury bills kept as security for SLR. Negotiable and highly liquid instruments are a part of treasury bills. As we talked about that commercial certificate of deposits are USAN's promissory note. Now what is a promissory note? As we have studied in accounting and at various other places of in commerce, it is a note payable in accounting. It is a contract detailing the term of promise by one party, that is the maker, to pay a sum of money to the other party, that is the payee. The obligation may arise from the repayment of a loan or from other form of debt. For example, in a sale of a business, the purchase price might be a combination of an immediate cash payment and one or more promissory note for the balance of the amount. There are various types of treasury bills. One is on-tap bill, ad hoc bill, auction treasury bills. Auction treasury bills are the most popular ones nowadays. On-tap bills could be purchased from the RBI at any point of time at an interest yield of 4.66%. These bills were discontinued from 1st of April 1997 as they had lost much of their relevance. Then there are ad hoc bills. Ad hoc bills were introduced in 1955. They were discontinued from 1st of April 1997 due to their irrelevance. Third type of bills are auction treasury bills. These auction treasury bills are most active money market instruments. They were introduced in April 1992. The RBI receives bids in an auction from various participants and issues the bill subject to the sum cutoff limit. The yield of this instrument is market determined. These bills are neither rated nor they can be discounted with RBI. Now, there are various types of auction that take place. Sale of treasury bill is conducted through an auction. There can be non-competitive bids also which are accepted. Types of auction include multiple price auction and uniform price auction. RBI invites bids by price. The bidder have to quote the price of the stock which they desire to purchase. Then bank decides the cutoff price at which the issue will be exhausted. Bid above the cutoff price are allotted securities, that is the multiple price auction. Second method is uniform price auction method. RBI invite bids in descending order and accept those that are fully absorb the issue amount. Each winning bidder pays the same price as decided by the RBI. Winning bidders are awarded the auction amount at the same price. This system was introduced on an experimental basis on 6th of November 1998 in case of 91 days treasury bill. Since 1999, 2091 day treasury bill auctions are regularly conducted on a uniform price basis. Now, who are the participants in the treasury bill market? The participants include RBI, banks, mutual funds, financial institutions, primary dealer, provident funds, corporates, foreign banks, foreign institutional investors. The state government can also invest in treasury bills, but they cannot issue the treasury bills. Fifth instrument of money market includes commercial bills. Commercial bills are those negotiable instruments which are drawn by the seller on the buyer, which are in turn accepted and discounted by commercial bank. It is a short-term negotiable and self-liquidating instrument with a low risk. Now, if we talk about commercial bills, all of the students would understand this, that commercial bills are bill of exchange. They are negotiable instruments. They are they are issued in the light of some consideration which is to be paid by one party to the other party at a future date, at a future time, and the amount is specified in that bill of exchange. So these companies, all the corporate houses who buy or sell goods on credit, they create debtors and creditors. So those debtors and creditors for whom the bill of exchange is written are known as bills receivable in case of debtors, and in case of creditors they are known as bills payable. Now, when a bank or a financial institution accumulate these bills receivables or these commercial bills, also known as bill of exchange, also known as in case it is on the creditor side, it is known as bills payable. So all of these bills, these can get anyone can get it rediscounted with a bank or any other financial institution at some rate of interest. So it enhances the liability to make the payment in a fixed date when goods are bought on credit. The working capital requirement of business firm is provided by banks through cash credit overdraft and purchase and discounted of commercial bills. So commercial bills are those bills which can be rediscounted at any platform, which is a bank or a financial institution where we can get it rediscounted. So a bank discounts these bills by keeping a certain margin and credits the proceeds. Bank, when in need of money, can also get such bill rediscounted by the financial institutions such as LIC, UTI, GIC, ICICI and IRBI. The maturity period of the bills vary from 30 days, 60 days to 90 days, depending upon the credit extended in the industry. There are various types of commercial bill. One such bill is demand bill. It is payable on demand. Usance bill. Usance bill is payable after a specified time. It is also known as time bill. Documentary bill. It is a bill where documents are delivered against payment accepted by the drawee and documents of the file are held by the banker till the bill is paid. Then there is a clean bill. These bills are not accompanied by any document that shows that a trade has taken place between the buyer and the seller. Because of this, the interest rate charged on such bills is higher than the rate charged on documentary bills. Another type of bill is inland bill. Inland bill are those which must be drawn or made in India and must be payable in India of drawn upon any person who is resident in India. Foreign bills are drawn outside India and may be payable in and by a party outside India, or may be payable in India or drawn on a party in India, or it may be drawn in India and made payable outside India. Hundi. Hundi is the original variety of bill of exchange for financing movement of agriculture produce. There are new instruments like derivative usance promissory note. To eliminating movement of papers and facilitating multiple rediscounting, the RBI introduced an innovative instrument known as derivative usance promissory note. There are two important money market intermediaries. These include Discount and Finance House of India (DFHI) and money market mutual funds. The Discount and Finance House of India was accredited as a primary dealer in February 1996. Its operations significantly increased, particularly in Treasury Bills and dated government securities. During these years, DFHI opened its branches at Ahmedabad, Bangalore, Calcutta, Chennai, New Delhi, and very recently at Hyderabad, with a view to catering to the requirement of small and medium-sized institutions operating at the centers and at the same time integrating the market with these regional centers with main money markets at Mumbai. The objective of DHFI is to even out the liquidity imbalances in the banking system, to promote secondary market in short-term money market instruments, to integrate markets at regional centers with the main market at Mumbai through its networks. It provides safe and risk-free short-term investment avenues to institutions. It provides greater liquidity to money market instruments. It facilitates money market transactions for small and medium-sized institutions who are not regular participants in this market. So, money market instruments in which discount finance House of India deals. These include Treasury Bills, dated government securities, certificate of deposits, commercial papers, call overnight money, notice money, term money, derivative usance promissory notes of commercial banks. Money market mutual funds were introduced in April 1991 to provide an additional short-term avenue for investment and bring money market investment within the reach of individuals. These funds invest the money in the money market instruments only, as their name suggests, money market mutual funds. So, just like other mutual funds in which we invest money, we can invest our money in money market mutual funds who will be investing the money in the money market instruments, and as per the returns or rate of interest which is going on in the money market, we can also get interest which we'll earn on the money market mutual funds. So, basically money market mutual fund bridges the gap between the small individual investors and the money market. It mobilizes saving from small investors, invests them in short-term debt instruments or money market instruments. It provides additional short-term avenue for investment. Let's talk about the link between the money market and the monetary policy in India. The monetary policy represents policies, objectives and instruments which is directed towards regulating money supply and the cost and availability of credit in the economy. Money market provides a balancing mechanism to even out the demand for and supply of short-term funds. The monetary policy in India is an adjunct of the economic policy. The objective of monetary policy are not different from those of economic policy. Money market provides a focal point for central bank intervention for influencing liquidity and general level of interest in the economy. In the monetary policy framework, broad objectives are prescribed and operating framework of policy instrument to achieve them is formulated. Money market facilitates the development of the market for longer term securities. RBI uses multiple instruments to ensure that appropriate liquidity is maintained in the system. Now, what are the tools for managing liquidity in the money market? There are reserve requirements of banks like CRR and SLR. Interest rates structures are there, bank rate which is defined by RBI and followed by all other commercial banks. Refinancing from the Reserve Bank is possible and repo rates are there. Now, what are repos? Repos are repurchase agreements. It is a transaction in which two parties agree to sell and purchase the same security at a different point of time. Under such an agreement, the seller sells specified securities with an agreement to repurchase the same at a mutually decided future rate and a price. The repo and the reverse repo transactions can only be done at Mumbai between the parties which are approved by RBI and in the securities which are approved by RBI, which include Treasury Bills, central and state government securities. Whenever the bank has any shortage of fund, they can borrow it from RBI. Repo rate is that rate of interest at which our bank borrows rupee from RBI. So, any reduction in the repo rate will help the bank to get more money at a cheaper rate. So, when repo rate are reduced and a high rate of interest is given on repo, that means it is the rate at which money is being borrowed from RBI and the bank is getting cheaper money. So, repurchase rate is the rate at which RBI lends short-term money to commercial banks. When the repo rate increases, borrowing from RBI becomes expensive. As on 4th of June 2019, reverse repo rate is 6%. Therefore, we can say, repo rate is 6%. Therefore, we can say that in case RBI wants to make it more expensive for the banks to borrow money, it increases the repo rate. Similarly, if it wants to make it cheaper for banks to borrow money, it reduces the repo rate. Second type of rate is reserve repo rate. Reverse repo rate is the rate at which banks park their short-term excess liquidity with RBI. The RBI uses this tool when it feels that there is too much money floating in the banking system. An increase in the reverse repo rate means that RBI will borrow money from the banks at a higher rate of interest. As a result, banks would prefer to keep their money with the RBI. Till 2011, reverse repo rate was an independent rate and was announced by RBI. However, after the monetary policy announcement on 3rd of May 2011, RBI has decided that now reverse repo rate will not be announced separately, but it will be linked to the repo rate. The reverse repo rate right now is 5.75%. Now, what is cash reserve ratio? It is a tool of monetary policy. Cash reserve ratio is the amount of funds that banks have to keep with RBI. So, if RBI decides to increase the percentage of this, the available amount with the bank comes down. Now, RBI is using this method to increase the CRR rate to drain out the excessive money from the banks. Before the enactment of this amendment in terms of Section 42(1) of RBI Act, the RBI could prescribe CRR for scheduled banks between 3% and 20% of the total of their demand and time liabilities. What is statutory liquidity ratio? Statutory liquidity ratio is the amount of commercial bank needs that any amount of commercial bank would need to maintain in the form of cash or gold or government approved securities before providing credit to its customers. Now, SLR rate is determined and maintained by RBI in order to control the expansion of bank credit. Every bank is required to maintain at the close of every business day a minimum proportion of their net demand and time liabilities as liquid assets in the form of cash, gold and unencumbered approved securities. The maximum limit of SLR is 40%. An increase in SLR also restricts the bank's leverage position to pump more money into the economy. Now let's talk about the developments in the money market that have taken place over all these years. Prior to mid-1980s, participants depended heavily on the call money market. The volatile nature of the call money market led to the activation of Treasury Bills market to reduce the dependence on call money. Later on, there was development of liquidity adjustment facility. Then the development of collateralized instruments happened. CBLO and market repos were introduced. Modifications in issuance norms and maturity profile of CDs and CPs happened. Clearing Corporation of India Limited was set up. So, a central counterparty was set up for money market instruments. Now, let's talk about this new kind of instrument, which is collateralized borrowing and lending obligation. This was operationalized as money market instrument by CCIL in 2003. It follows an anonymous, order-driven and online trading system. On the lender's side, main participants are mutual funds, insurance companies. Major borrowers are nationalized banks, primary dealers and non-finance companies. It is a money market instrument as approved by RBI, is a product developed by CCIL. CBLO is a discounted instrument available in electronic book entry form for the maturity period ranging from 1 day to 90 days and can be made available up to 1 year as per the RBI guidelines. In order to enable the market participant to borrow and lend funds, CCIL provides the dealing system through Infinite Indian Financial Network, which is a closed group of members of Negotiated Dealing System NDS who maintain current account with RBI. Internet gateway for the other entries who do not maintain current accounts with RBI. What is CBLO? It is explained as under: it is an obligation by the borrower to return the money borrowed at a specified future date, an authority to the lender to receive the money lent at a specified future date with an option to transfer the authority to another person for the value received, an underlying charge on securities held in custody for the CCIL for the amount borrowed and lent. Next instrument is collateral loan market. It is also one of the one of the monetary policy instrument which is available for controlling the supply of money in the economy. The market for loans, which is secured by stocks and market, is geographically most diversified and most loosely organized. The loans are generally advanced by the commercial banks to private parties in the market. The collateral loans are backed by the securities, stocks and bonds. Another instrument is acceptance market. It is very old form of commercial credit. It refers to the market for bankers' acceptance involved in trade transactions. It deals with bankers' acceptances, which may be defined as draft drawn by a business firm up to a bank and accepted by it. A draft drawn by an individual or a firm upon a bank and accepted by the bank, whereby it is ordered to pay to the order of the designated party or to the bearer a certain sum of money at a specified time in future. The intermediaries in the money market are known as primary dealers. Now, what are primary dealers? It is a system of primary dealers in government security market, which was introduced in 1995 by RBI to strengthen the market infrastructure of government securities. Discount and Finance House of India was set up by RBI in March 1888 to activate the money market. It got the status of primary dealer in February 1996. Over a period of time, RBI divested its stake from DFHI and became a subsidiary of SBI. SBI has also set up a subsidiary in 1996 for doing primary dealer business, namely SBI Gilts Limited. Both of these companies were merged in 2004 to become the largest primary dealer in the country. Primary dealers are also known as merchant bankers for dealing in the money market instrument or government securities. So they are merchant bankers for the government of India, as they are allowed to underwrite primary issues of government securities other than RBI. Now, as primary dealer, they are allowed to do various activities. They are allowed to deal and underwrite in government securities. They are dealing in interest rate derivatives, providing broking services in government securities, dealing and underwriting in corporate, PSU and financial institution bonds and debentures, lending in call, notice, term, repo and CBLO market, investment in commercial papers, investment in certificate of deposits, investment in debt mutual fund where entire corpus is invested in debt securities. Now let's talk about that how money markets are behaving outside India. That's internationally how money markets in other economies are working. So central banking in developed countries such as Reserve Bank of New Zealand, Reserve Bank of Australia and Bank of England have adopted price stability as their sole objective by adopting an inflation targeting framework. US and Japan continue to pursue dual objective of price stability and growth. South Africa, Thailand, Korea, Mexico focus solely on price stability and adopt an inflation targeting framework. The major participants in the US money market are commercial banks, governments, corporations, government-sponsored enterprises, money market mutual funds, future market exchanges, brokers and dealers and the Fed. In the UK, trading in the money market takes place on an over-the-counter basis for the same-day settlement. The money market attracts a wide range of participants such as government, banking sector, industry and financial institutions such as pension funds. In the Euro system, the ECB, National Central Bank, government and the eligible credit institutions participate in the money market. In Australia, the central government, state and the territorial governments and Reserve Bank of Australia. Banks, government agencies and other governments of Commonwealth and other supranational institutions are major participants. In Canada, the participants include both federal and provincial governments, banks, major crown corporations such as Canadian Wheat Board and Federal Business Development Bank. In Japan, business units of Japanese and non-Japanese bank located in Japan participate in the uncollateralized market to raise the funds. The majority of participants in the uncollateralized overnight call market are the city banks, which have the largest share as borrowers, while regional banks act as major lenders. So looking at all of the international markets, we understand that Indian money market is very popular and is growing very well. And over these years, the maturity has come in the Indian money market. So, as we have today covered various type of instruments of money market, so these money market instruments have grown over time. They required certain set of functions to work smoothly, like there was a requirement that the banking system should be well stabilized. So now we have a very well organized banking system in India. So based on that banking system, we can afford to, the central bank is strong, there are commercial banks who are doing very well, and there's private sector banks, foreign banks, there are other financial institutions, NBFCs, so they are also allowed to participate in various type of in various ways as players. So looking at the organized banking sector, it was thought that money market can flourish in India, money market can improve and develop in India. So very nice money market instruments are available. So basically money market instruments are those which are used for investment for a period of less than 1 year. So these are those instruments which have a maturity of less than 1 year. These include the call money market instruments, notice money. So call money instruments are those. Now call money and notice money are these are the two instruments which are used only by the banking sector. So if one bank has a shortage of fund, another bank has surplus of funds. So at the end of the day, each bank is supposed to maintain the CRR and the SLR requirement, that is statutory liquidity ratio requirement. Now based on the CRR and the SLR limits of those banks, it can happen that one particular bank branch or one particular bank is having shortage of fund at the end of the day. Now where to fulfill that shortage requirement? So they can contact another bank branch and borrow money for just 1 day, so that they can fulfill the obligation that has come for CRR and SLR requirement, or any other obligation that has come for let's say a depositor has come to withdraw his money, or there's a fixed deposit that is going to be matured, and for that purpose one bank is having shortage of fund for today, and he needs to meet that shortage. So from where he can borrow money? He can borrow money from another bank who has surplus of fund at the end of the day, and he can borrow it at a rate of interest. So that rate of interest is call rate. So if the money is borrowed by one bank from another bank for 1 day period, that is known as call money, and there's a rate of interest which they have to pay to each other for that. Another type of interbank transaction instrument which is available is notice money. Now notice money instrument is available for 15 days time period. So if one bank is borrowing from another bank for meeting the short term requirement of funds, so then it is known as notice money, and if that requirement is met for 15 days. So up to 15 days if money is lent and borrowed between two banks, it is known as notice money, and in return they will pay a rate of interest on it. Third instrument is term money. Now term money can be any loan which is given by one bank to another bank for a period of less than 1 year. So these are interbank transaction instruments for meeting the CRR SLR requirement, and very popularly used between various banks at various time period. Second instrument which is again popular is certificate of deposits. Certificate of deposit are those instruments which are issued as a promissory note by one financial institution, basically a bank or any other financial institution which is allowed by RBI to issue the certificate of deposit. So they are issued for a period of 7 days to up to 1 year. So that's the time limit, and in the multiples of 1 lakh they can issue this amount. Who can buy these? It is again bought by the financial institutions. So any financial institution can buy these commercial these certificates of deposit, and these are easily transferable by endorsement, because it is a promissory note which is a negotiable instrument. Whosoever will be carrying it, whosoever will be endorsed, he can collect the payment at the time of maturity on it. So there's these are usually issued at a discount and payable at par. And again, banks and financial institutions issue it, and any big financial institution can participate and purchase these certificate of deposits. Another next important instrument, again these are being used for the CRR and SLR requirements. These commercial certificate of deposits have to be stamped, and they are issued at a discount at the face value. Apart from that, there are other instruments like commercial papers. Now commercial papers are those negotiable instruments which are issued by any corporate house. So corporate houses, when they are allowed to issue to borrow money from public, from other financial institutions, so they issue commercial papers. So these commercial papers have to be rated. So there has to be a credit rating agency who is going to rate these commercial papers, and these can be purchased by individuals. They can be purchased by banking and other companies, other corporate bodies which are registered in India and which are they are incorporated in India. Main player in this market includes leasing and finance companies. So they are the ones who would like to buy it and who participate in these commercial papers. And apart from that, they are issued for a denomination of minimum of 5 lakh and in the multiples of 5 lakh thereof. Minimum period for this issuing of commercial paper is 7 days up to a limit of maximum of 1 year. And so the corporate house has to meet the working capital requirement, has to meet the net worth requirement before they are allowed to issue the commercial paper, and they are allowed to issue commercial paper based on the permission given by RBI. A very important instrument where if government wants to borrow money from public, then government borrows it through the government securities which are known as in the form of Treasury Bills. So these Treasury Bills is again a very important instrument. It is very safe instrument. It is also termed as a risk-free. The rate of interest which we give on the Treasury Bill is the risk-free rate of interest, because there is no default which can be made by the government on these bills, and these are issued for a time period of 91 days up to a period of 364 days, and these are available in the auction market to be purchased. And these Treasury Bills help the government to borrow money from general public. Now overall, with the because of the development in the money market instruments, the Indian economy has been able to grow very well, because the growth of Indian economy is based on the various instruments, how well the money market is growing in India. So based on if we talk about the objectives of money market, it is one major instrument through which the monetary policy can be governed. So RBI use it as an instrument for maintaining the CRR, SLR requirement, the repo rates which are available, the bank rate which is available. So for that purpose, RBI is using this particular market. Money market has been able to bring out the economic development of the country. It leads to a lot of profitable investment, because whenever a bank is having idle money or any institution is having idle money for a short period of time, they can always invest in money market instrument. And nowadays there are other newer money market instruments which are available, which can be purchased by individuals also in the form of money market mutual funds. So anybody who wants to make short-term investment in money market, because general public is not allowed to participate in it, we can invest it through the money market mutual fund instruments. Apart from that, it is one major source from where government borrows the money. It is very important for central bank, because central bank is trying to implement the monetary policy through this. Mobilization of funds is possible from those who have surplus to those who have deficit. It is also possible with the help of money market. Money market has brought in self-sufficiency in commercial banks, because interbank transaction can lead to growth in the bringing the self-sufficiency factor in the economy. Apart from that, saving and investment is also boosted up with the help of money market. So that's all for today, and I would be very happy to see your take up your questions in case there are any questions on this topic, and next time we'll come up with another topic related to financial markets and institutions. Thank you.